Hello, good afternoon. This is the topic about auditing problems that will cover specifically some problems in the audit of liabilities. And then after that, I will tackle the audit program guide for shareholders equity. Let's proceed immediately to this particular problem that pertains to the audit of notes payable. The story is about Balsi Company. On October 1, 2020, Balsi Company issued a 500,000 peso 12-month, 12% note to Aliana Company in payment of account. Let me explain the first sentence. This pertains to the indebtedness of Balsi Company to Aliana. Aliana is the one who issued the promissory note. Therefore, there is a payable on the books of Balsi. Balsi is the one who issued the promissory note to Aliana. So Balsi has indebtedness to Aliana amounting to 500,000 pesos. So on the same date, the company borrowed 1 million pesos from Allied Bank by signing a 12-month non-interest bearing 1,120,000 note. So this is another promissory note. In other words, we have two promissory notes in this discussion. The first one is about the 500,000 pesos liability to Aliana Company. The second one is the 1,120,000 pesos liability to Allied Bank because Balsi Company borrowed money from Allied Bank. What can you notice about the amount? Balsi Company received 1 million pesos from Allied Bank. But the amount of promissory note issued by Balsi to Allied Bank is 1,120,000 pesos. So we have a difference of 120,000 pesos. Balsi received only 1 million, but Balsi will pay 1,120,000 pesos to Allied Bank after 1 year. So the difference of 120,000 pesos will be treated as discount on notes payable, which will be subject to amortization or adjustment at the end of the year and upon the full payment of the note. You are the auditor assigned to examine notes payable, and you noticed that no adjusting entries were made on December 31, 2020, and other information was missing. In this regard, you are asked as an auditor to prepare proposed adjusting entries at December 31, 2020, and number 2, what is the net liability to be reported on December 31, 2020, a statement of financial position for letter A, interest-bearing note, and letter B, non-interest-bearing note. What can you notice about the word proposed? We are using the word proposed on problems pertaining to auditing because the auditor will just make a proposal to the auditee. In this case, the auditee or the company being audited is Balsi Company. So the auditor will propose to Balsi the possible adjusting entries. It is up to Balsi whether they will comply with the proposal of the auditor. That is why you may notice in auditing problems, we are using the word proposed when it comes to adjusting entries. And under question number 2, what can you notice? We are asked to present the net liability for the interest-bearing note and the non-interest-bearing note. The interest-bearing note pertains to the promissory note payable to Aliana, because in the problem, the interest of 12% is clearly stated. But under letter B, the non-interest-bearing note pertains to Allied Bank, because no interest rate was mentioned regarding the promissory note issued to Allied Bank. So that is why it is called non-interest. But in actuality, so if you will analyze the situation or any kind of situation just like this, there is no such thing as non-interest bearing note. Actually, there is interest here. It is hidden in the promissory note of 1,120,000 pesos. The interest here is actually 120,000 pesos hidden because the amount received by Balsi is 1 million, but Balsi will pay 1,120,000 pesos after 1 year. Let's continue. So here is the solution to Balsi Company. We will first answer requirement number 1. Prepare propose adjusting entries at December 31, 2020. So let's compute for the interest to be recognized as with regards to the proposed adjusting entries. For the indebtedness to Aliana, this is the computation of interest. The amount of promissory note is 500,000 pesos multiplied by 12%, multiplied by 3 months, divided by 12 months, that is 50,000 pesos. We use 3 months because that is from October to December 2020. So that is the amount of interest to be paid to Aliana. And then for Allied Bank, the amount received by Balsi from Allied Bank is 1 million pesos. We will multiply this by 12%, multiplied by 3/12, that is 30,000 pesos. Some of you may question, we thought the loan to Allied Bank is a non-interest bearing note. Why are you multiplying 1 million by 12%? Actually, 12% is just a presumption because there is a difference of 120,000. When we compare the amount received of 1 million with the amount of promissory note of 1,120,000 pesos, there is a difference of 120,000 pesos. If we will divide 120,000 pesos by 1 million, we have a 12% interest. That is why this first computation, multiplying 1 million by 12% is just a presumption. But in order to correct or in order to check the correctness of this assumption, we may use another computation. That is 120,000 pesos divided by 12 months because the term of the note is 12 months. That is 10,000 pesos per month multiplied by 3 months, that is from October to December, we arrive at the same amount of 30,000 pesos. So, based on this computation, it is safe to declare that the interest expense to be paid to Allied Bank is 30,000 pesos. So this is now the adjusting entry, debit, interest expense, 15,000 pesos. This pertains to the indebtedness to Aliana. We will credit accrued or interest payable of 15,000 pesos. We may also use the account title, accrued interest payable. So this is the first promissory note mentioned in the problem. And then we will debit interest expense amounting to 30,000 pesos, the indebtedness that pertains to Allied Bank. So we debited interest expense and we will credit discount on notes payable. So here you can notice that this particular promissory note incurred interest of 30,000 pesos. And then these are some of the explanations. I just wrote down the explanations that I have done previously just to document my verbal explanation. The amount received from Allied Bank loan is 1 million, while the amount written in the non-interest bearing note is 1,120,000 pesos. So in effect, the difference of 120,000 pesos is the discount on notes payable, which is subject to amortization based on the term of the loan. So we are not saying that 120,000 pesos is the interest. We are saying that it is the discount on notes payable. So how are you going to present the discount on notes payable? It is presented in the statement of financial position as a deduction from the liability of notes payable. So any balance of discount on notes payable shall be reversed on the date of final payment on October 1, 2021, charged to interest expense. That is how we use the discount on notes payable. So let's continue. So question number 2, what is the net liability to be reported in December 31, 2020 statement of financial position? For letter A, the interest-bearing note. So here is the presentation. The notes payable to Aliana is 500,000 pesos. And then we will add the interest payable that we computed a while ago. That will be included in the liability to Aliana. And that is 15,000 pesos. Therefore, the total liabilities for Aliana Company is 515,000 pesos. So the second one, we will compute for the net liability that pertains to the second one, the non-interest bearing note or the liability to Allied Bank. The notes payable as given in the problem is 1,120,000 pesos. And then we will deduct whatever is the balance on notes payable. So what will be deducted in this particular presentation is 90,000 pesos. Because we already recognize the 30,000 pesos interest expense. That is why we have only here 90,000 pesos. So the carrying value of the notes payable is 1,030,000 pesos. So as we have said, the original amount of discount on notes payable is 120,000 pesos. Since we already recognized in our journal entry the 30,000 interest, the remaining balance of discount on notes payable at the end of the year is 90,000 pesos. The amount deducted from the original amount of notes payable of 1,120,000 pesos. So what is the journal entry on the date of payment? Because the notes payable for both indebtedness should be settled after 1 year, that is October 1, 2021. So we will now fully settle. What is the journal entry? Of course, we will debit notes payable 500,000 pesos. This pertains to the indebtedness to Aliana Company. And then we will debit interest expense. This particular interest expense pertains to the interest expense covering the period from January 1 to October 1, or 9 months. And the amount computed is 45,000 pesos. I will show to you later how we arrive at 45,000 pesos interest expense. And then we will debit interest payable. This is the interest expense already incurred but not yet paid in 2020. We recorded it to interest payable. That is why on the date of settlement, we will reverse the interest payable, and that is 15,000 pesos. And of course, we will debit cash for the total amount of 560,000 pesos. Try to check 500,000 pesos multiplied by 12%. Try to check 500,000 pesos multiplied by 12%. That is 60,000 pesos. So if we will add 60,000 pesos from the face amount of the promissory note of 500,000 pesos, the total is 560,000 pesos. So here is the computation of interest. 500,000 pesos multiplied by 12%, multiplied by 9 over 12. That is 45,000 pesos. Why 9 over 12? Because it covers the period from January 1 to October 1, that is 9 months. So this is now the journal entry for the settlement of liability to Allied Bank. We will debit notes payable of 1,120,000 pesos. And then we will debit interest expense also. So how much is the interest expense to be debited in this case? That is 90,000 pesos. Actually, this 90,000 pesos is the remaining balance of the discount on notes payable. That is why we will also credit discount on notes payable of 90,000 pesos. So we will credit cash for the whole amount of 1,120,000 pesos. Let's proceed to our second problem. To net company. Described below are certain transactions of the net company. So number 1, on April 1, 2020, the corporation bought a truck for 400,000 pesos from Grant Motors, paying 40,000 pesos in cash and signing a 1-year 12% note for the balance of the purchase price. So take note, there is a down payment of 40,000 pesos. The cost of the truck is 400,000 pesos. We will deduct the down payment. Whatever is the difference is the promissory note to Grant Motors. And then, on May 1, 2020, the corporation borrowed 800,000 pesos from Pacific Bank by signing a 920,000 pesos non-interest bearing note due 1 year from May 1, 2020. So, what can you notice about the amounts? Just like in the previous problem, Tonet Company received 800,000 pesos cash from Pacific Bank. But the promissory note or the amount to be paid after 1 year is 920,000 pesos, leaving a difference of 120,000 pesos. As the auditor assigned to examine the records of notes payable, you are given the task by your supervising auditor to prepare proposed adjusting entries as of December 31, 2020 for the above transactions. So let's continue. This is now the solution to Tonet Company. So the first adjusting entry is a debit to interest expense. Here is the computation. So the amount of truck purchased by Tonet is 400,000 pesos. And there is a down payment of 40,000 pesos. Therefore, the amount of promissory note is 360,000 pesos, which is now the basis in the computation of interest. That is why we multiply it by 12%, multiplied by 9 months, divided by 12 months. That is 32,400 pesos. Why 9 months? Because it started from April. So from April to December, that is 9 months. So the amount is 32,400 pesos. So the interest for Pacific Bank will be computed as follows. 920,000 pesos is the amount of promissory note. The amount of money received from Pacific Bank is 800,000 pesos. Therefore, there is a difference of 120,000 pesos, which will be regarded also as a discount on notes payable. We will divide this by 12 months. That means 80,000 per month. So, we will debit, or not 12 months, we will multiply 120,000 multiplied by 8 months divided by 12 months. Why 8 months? That is from May 1 to December 31. So the amount is 80,000 pesos. So the first debit is debit interest expense of 32,400 pesos. And credit accrued interest payable of the same amount that pertains to the interest to be payable to Grant Motors. The second one, debit interest expense also for 80,000 pesos. And then we will credit discount on notes payable of 80,000 pesos. So these are the adjusting entries for Tonet Company. So let's now proceed to the audit of shareholders' equity. Before we proceed to the problem-solving exercises, we have first to discuss the Audit Program Guide. The Audit Program Guide is the tool being used by auditor in conducting field audit. Just like a soldier when going to the war is equipped with guns and ammunitions. In the same manner, an auditor is equipped by this gun and ammunition. We call it Audit Program Guide. You cannot imagine an auditor conducting an audit without any audit program guide. There will be no direction. So in audit, for every account title, there should be an audit program guide. There is one audit program guide for cash, receivables, inventory, investments, and so on and so forth. That is why in the audit of shareholders' equity, we are presenting here the audit program guide, which will serve for every auditor in conducting an audit. The audit program guide is divided into two: the audit objectives and the audit procedures. The audit objectives are the things that we want to happen in the conduct of audit. We want to see the results of our audit, while the audit procedures are the step-by-step actions to be undertaken by the auditor in order to achieve the audit objectives. So let's discuss first the audit objectives. The first one, to determine board or shareholders' approval of transactions pertaining to shareholders' equity, examples of which are dividend declaration and payment, appropriations, issuance of shares, and other matters pertaining to shareholders' equity. What do you mean by shareholders' approval or board of directors' approval? Because all transactions pertaining to shareholders should be known to the shareholders and the board of directors themselves, particularly the board of directors who represents the shareholders. That is why it is being emphasized in the number one objective that there must be an approval. If the company declared dividends, there must be an approval. What is the journal entry upon the declaration of dividend? Debit, retained earnings, and credit, dividends payable. What is the journal entry when there is appropriation coming from retained earnings? Debit, retained earnings unappropriated, and credit, retained earnings for certain appropriations. Whenever you issue share capital, there will be a journal entry: debit cash, credit ordinary share capital, or preference share capital. In audit, every journal entry must be supported by documents. Here we can see the difference between accounting and auditing. In accounting, we are just concerned with journal entries and preparation of financial statements. In auditing, we are concerned on the analysis of every transaction and every journal entry. In auditing, we want to make sure that every transaction is supported by documents. When you are conducting an audit, example in this case, you saw a journal entry debiting retained earnings and crediting dividends payable. What will be the document to be verified? It is the board resolution. The board resolution signifies approval for every dividend declaration. The corporation is not supposed to declare and pay dividends without the approval of the board. So, the document that you are going to retrieve to verify the validity of the dividend declaration is the board resolution. What is a board resolution? The board resolution is simply the minutes of the meeting during the board meeting. The board resolution simply signifies the things that they have approved, the things that they have agreed upon during the meeting. If the board agreed that there will be dividend declaration, that should be clearly written in the board resolution. The amount of dividend to be declared, the number of shares, and so on and so forth shall be clearly stated in the board resolution. And the journal entry must coincide with what has been stated in the board resolution. So if the company will appropriate, example, the company is planning to purchase software, the amount is big enough that needs board approval. In that case, the company will appropriate a certain amount for the purchase of a software. So that particular appropriation in retained earnings should be approved by the board through issuing board resolution. That is the reason why this number 1 objective was here, in order for the auditor to be guided on what documents should be obtained from the audit. Objective number 2, to determine if transactions involving shareholders' equity were in accordance with the accounting standards. So, everybody is familiar with the Philippine Financial Reporting Standards and the Philippine Accounting Standards. It is understood that if you are the auditor, you are knowledgeable on these standards, and the presentation of the shareholders' equity in the statement of financial position should be in accordance with our accounting standards. To determine if the provisions of the Corporation Code with regards to capitalization were complied. So, in conducting an audit of the shareholders' equity, you must be knowledgeable not only on accounting standards, but also on the provisions of the Corporation Code. Please remember, we have new Corporation Code that allows one person only to put up a corporation, and we call it one-person corporation. So, if you are conducting an audit of a corporation, don't be surprised if you can see a corporation established by one person only. With regards to the capitalization of a corporation, there are specific provisions of the law. Always remember, ladies and gentlemen, that the corporation is not supposed to issue share capital in excess from what has been approved by the Securities and Exchange Commission. We call it authorized share capital. All issuances of number of shares is not supposed to exceed the authorized share capital. As an auditor, you are mandated and duty-bound to verify if these corporations are following the law. Then, number 4 objective, to ascertain if the presentation of shareholders' equity was in accordance with the accounting standards, and appropriate disclosures in the notes to financial statements were made. Do not neglect the notes to financial statements. There are some instances that some corporations are penalized by the regulatory bodies for failure to disclose significant matters in the notes to financial statements. If there are some items that need to be disclosed in the notes to financial statements concerning shareholders' equity, the same shall be done in order to avoid possible penalty from regulatory bodies. Let's now proceed to the audit procedures. As we have said, when we say audit procedures, we are referring to the step-by-step actions to be undertaken by the auditor in order to achieve the audit objective. So that is the purpose of the audit procedure. The audit procedures are there in order for the auditor to verify the attainment of every audit objective. So let's discuss the audit procedures one by one. The first one, obtain copies of corporate documents like board resolution and articles of incorporation, and ascertain if the authorized share capital was in accordance with what has been approved by the SEC. So this is what I am discussing a while ago. So the corporation is not supposed to issue share capital in excess to the number of shares authorized by the SEC as stated in the articles of incorporation. If the stated par value is the same with what has been recorded, and if the declared preference share was in accordance with the articles of incorporation. So you may notice, you may encounter some problems in auditing and accounting about par value and stated value. So let me explain. When we say par value, it is the value of the share capital per share is stated, written clearly in the share capital certificate. Because if you are a shareholder, you will receive a certificate of ownership, and we call it share capital certificate. In our time, we call it stock certificate. The value per share is written on the face of the share capital certificate. We call it par value. In some instances, there is no par value written on the face of the share capital certificate. In that case, what will be the basis of the corporation whenever they issue share capital? The basis will be the stated value. What is the stated value? The stated value is the value per share written in the articles of incorporation. That is why it is called a stated value, because it was stated as one of the provisions in the articles of incorporation. Of course, you have to recognize premium whenever the share capital was issued in excess of the par value or stated value. And then, number 2 procedure, get a copy of the schedule and ledger of the subscribed share capital and treasury share, and check the correctness of balances as compared with the board resolution and articles of incorporation. So this is very basic among the auditors. When we say ledger, do not forget, in actual practice, most corporations today, or I think about 99% of the corporations today are using computerized accounting system. So when we say ledger in this case, we are referring to the printout ledger generated by the system. So whenever you ask the accountant to give you a copy of the ledger, the accountant will just generate the ledger coming from the system. When we say ledger, we are referring to the ledger of subscribed share capital, the ordinary share capital, preference share capital, treasury share, and check the correctness of balances as compared with the board resolution and articles of incorporation. So what do you mean by treasury share? So the treasury share can best be illustrated in this example. Example, I am a shareholder of ABC Corporation. I want to withdraw my capital. I want to withdraw my investment. Actually, I cannot do that because this is not a single proprietorship business. This is a corporation. But the question is, how can I get my money? How can I recover my investment if I want to go out of the corporation? Actually, I can do that by selling my share to other investors. If another investor is willing to purchase my share, that is the time that I can recover my money. The next question is, suppose nobody wants to buy your share. You are trying your best to sell your share capital, but nobody is interested to buy. In that case, since you want to get your money, the corporation has no choice but to purchase your share capital. It is the corporation who will purchase your share capital because you want to go out as an investor. And if the corporation will purchase your share capital, we call it treasury share. Why is it called treasury share? Because I will give to the corporation my share capital certificate. And the share capital certificate that I surrender to the corporation will be given to the treasurer of the corporation. The treasurer of the corporation will be the custodian of all the share capital certificates purchased by the corporation. That is why it is called treasury share. When the corporation purchased my share capital, the journal entry in the books of the corporation will be debit, treasury shares, and credit cash, because the cash was given to the shareholder who wants to go out of the corporation. Audit objective number 3. Check the correctness of journal entries that pertains to the issuance of share capital, treasury shares, and retained earnings. Documents needed are journal and check vouchers as well as board resolutions. So we are mentioning here journal voucher and check voucher. As an auditor, you must know the difference between the two. So when you say check voucher, this is the document that will support issuance of check for the disbursements. We call it voucher because the document vouch the validity of the issuance of check, because the voucher itself shows the signature of the persons responsible in the process of preparation of the check disbursement. That is the reason why it is called voucher. It vouch or endorse the validity of the transaction. In other words, whenever you encounter the terminology check voucher, we are referring to the document that supports issuance of check for any kind of disbursement. When you say journal voucher, we are referring to the document that will support non-cash transactions. Examples, adjusting entries. Adjusting entries does not involve cash. Depreciation expense. Whenever you recognize depreciation expense, there is no cash involved. So that is why we will use journal voucher for those transactions not involving check issuance. That is the reason why, as an auditor, you must know how to distinguish the two, so that you will be respected by the auditee because you know what you are doing. So, if you want to check the correctness of the journal entries, the best document to verify are the vouchers. Because on the face of the vouchers themselves, the journal entry are written or printed on that particular document. And also, do not forget to conduct inventory and inspection of treasury shares. As we have said, the share capital purchased by the corporation is in the custody of the treasurer of the corporation. So you will inspect and do an inventory of the share capital certificate purchased by the corporation in the custody of the treasurer. So the total amount must tally with what has been recorded as treasury share as of the cut-off date. And then you have to obtain list of shareholders and their corresponding outstanding shares. The total must be the same with what has been recorded. Example, actually, as I have said, most of the corporations are computerized. So whenever you request for a list of the shareholder, what will be given to you is a computer printout showing the listing of the shareholders and their corresponding investment, and there is a total at the bottom of the printout. So verify the total. Whatever is the total reflected in the printout must be the same with what has been represented as total share capital. That is how you do the audit. And then procedure number 6, send confirmation letters to shareholders with subscription receivable. Investigate any discrepancy on the confirmed amount. So you are familiar with confirmation letter. Usually this is being used when you conducted an audit of receivables, particularly notes receivable. You send confirmation letters to the customers to confirm the legitimacy of the balance of notes receivable of some clients. But in this case, you will send confirmation letters, not to the clients, but to the shareholders with unpaid subscription. Actually, they are not really shareholders yet. They are called subscribers because the investment is not yet fully settled. There are still subscription receivable. So you will confirm the validity and legitimacy of the balance of subscription receivable by sending confirmation letters to the subscribers. We call it subscribers because they are not yet fully considered as shareholder. They are not yet a full-fledged shareholder. Again, the objective is to ascertain correctness of the balances of subscription receivable. And then audit procedure number 7, check if the dividends paid to shareholders are in accordance with what has been written in the board or shareholder minutes of the meeting. Actually, this is the one that I discussed a while ago. When you verify the board resolution, the amount approved for the dividend declaration and payment must be in accordance with the board resolution. The amount must be the same with what has been written in the journal entry. Audit procedure number 8. Obtain and retrieve the latest general information sheet, articles of incorporation, and the needed board resolution if these were submitted and duly acknowledged by the Securities and Exchange Commission. So the corporate documents must be acknowledged and received by the SEC. How can we determine if these documents are properly acknowledged? Look for the stamp receipt. So once you present, once you submit these documents to the SEC, they will receive and stamp and affix the signature of the person receiving. As an auditor, you look for the stamp received by SEC personnel to make sure that these documents are duly acknowledged by them. Because if these documents were not acknowledged by SEC, these are not valid documents. So let me explain what is the meaning of general information sheet. So as an auditor, you must know this. The general information sheet is the list of all officers of the corporation. Remember, officers are different from the board members. The board members are the owners of the corporation, while the officers are just employees. The officers are the president, the executive vice president, the different vice presidents, and all other significant officers of the corporation. The names of these people are written in the general information sheet and should be submitted to the Securities and Exchange Commission. Every year, the SEC requires every corporation to submit general information sheet because very frequently corporations change their officers. There may be some changes because of retirement or resignation or promotion. That is why these changes should be effected in the latest general information sheet and should be submitted to the SEC. Because if you will not submit the updated GIS, your corporation may be penalized once this matter came to the attention of the SEC. That is how important these documents to them. What is the logic? Because they want to see the continuity of the business existence. That is one of the functions of the SEC. Aside from registering your corporation, they want to see the continuity of the business existence. That is why the corporation must always update what documents have been submitted to them. As an auditor, it is your duty to verify this submission of documents to this government regulatory body. And then, as part of your audit procedure, you get a copy of the latest financial statements and check if adequate disclosures on significant accounting policies on shareholders' equity and other related transactions were done. Remember, as I discussed a while ago, please do not neglect the inclusion of significant matters in the notes to financial statements. This was discussed in your intermediate accounting regarding disclosure. So you must always disclose significant matters, because if this will be known to the regulatory body, the corporation, including the external auditor, will be penalized. That is how important this procedure. So that ends my presentation regarding the audit program guide for shareholders' equity. I will continue our discussion next meeting. Thank you and God bless.